Good morning. I'd like to call this meeting of the Council to order. Thank you for joining today's meeting, and I'd like to note that Director Seitz is joining us virtually today. We have two items on the agenda. First, we'll hear a presentation on the Council's 2024 annual report, followed by a vote on issuing the report, and then we'll vote on the minutes of our last meeting. Our first agenda item is the Council's annual report. This past year, the U.S. economy has been marked by a combination of developments that few thought possible. Inflation is down significantly, the unemployment rate is near historic lows, and economic growth is robust. This is the result of actions we've taken over the past 4 years, including our administration's focus on strengthening the resilience of the U.S. financial system. A resilient financial system is critical to a strong economy. And as the Financial Stability Oversight Council's 2024 annual report shows, the Council has played a key role in increasing the resilience of the U.S. financial system. Today, I'd like to speak to ongoing progress in 3 key areas, starting with the banking sector. In March of 2023, we acted quickly and decisively to prevent contagion from regional banking stress that could have destabilized the U.S. financial system and undermined our historic economic recovery. Since then, the Council has provided direction and helped lead coordination among regulators to address core weaknesses the banking stresses revealed. As the annual report lays out, we need to continue work to ensure that banks are prepared for liquidity stress by making sure that they have diverse sources of contingency funding and the capacity to borrow at the discount window. And we've also remained focused on credit risk in commercial real estate. This risk became more evident this year, and regulators should continue to focus on the financial industry's ability to address it. We've also been addressing emerging risks from significant technological changes. Digital assets and artificial intelligence bring potential benefits, such as efficiencies, but also financial risks, cyber risks, and risks from third-party service providers. The Council continues to call for legislation to create a comprehensive federal prudential framework for stablecoin issuers and for legislation on crypto assets that addresses the risks we've identified. And we recommend building further interagency expertise to analyze and monitor potential systemic risks associated with the use of AI in the financial services sector while facilitating innovation. Treasury's report on AI-specific cybersecurity risks is one example of recent progress, equipping financial institutions with information on best practices. Efforts like Treasury's Project Fortress, which brings more than 1,000 financial institutions together to combat cybersecurity risks, are also key. And strengthening the resilience of the U.S. Treasury market has continued to be a top priority, with the Council playing an important coordinating role. We've made progress, including on increasing the availability and quality of data on Treasury market and repo activity, to advance transparency, and on evaluating the use of leverage that could increase risk to Treasury market liquidity. Treasury also launched a new buyback program to bolster liquidity. This work must continue as we move forward to implement expanded central clearing of Treasury securities and to improve risk management. Across these areas, progress has been enabled by a strengthened Council. When I took office, the council staff at Treasury had been cut to single digits, and the infrastructure supporting interagency coordination had been scaled back significantly. This meant we were less equipped to identify and respond to risks to the financial system. So we invested in the council, increasing staff, creating more opportunities for agencies to come together, and developing new tools, such as the Analytic Framework for Financial Stability Risks, which we published last year. The strengthened council has delivered, helping make our financial system more resilient and our economy stronger. And it's crucial that it continue to do so for the benefit of the American people. Let me now turn to Sandra Lee, Deputy Assistant Secretary for the Council at Treasury, and Stefan Jasowitz, Assistant Vice President at the Federal Reserve Bank of Kansas City, to present the 2024 annual report.
Thank you, Madam Secretary. FSOC staff appreciates the opportunity to provide additional detail about the FSOC annual report. I also want to acknowledge and thank FSOC agency staff for all their contributions, and I also want to thank the FSOC Secretariat staff for all of their hard work to prepare this year's report. Over the past year, the Council continued its work to identify and address vulnerabilities in the financial system, including advancing efforts to improve the resilience of Treasury markets and to assess risks posed by non-bank financial intermediaries, digital assets, and climate-related financial risk. Earlier this year, the Council released its report on non-bank mortgage servicing, which documents the important role that non-bank mortgage servicers play in the mortgage market and provides recommendations to enhance their resilience. The Council also reconvened its Committee on Financial Market Utilities to restart interagency analysis of FMU developments and complete a review of FMUs currently designated as systemically important by the Council. The Council also made further progress on a framework to better measure how climate-related financial risks can impact financial institutions. In addition, the Council took steps to monitor and identify potential systemic risks posed by the rapid and growing use of artificial intelligence. The Council advanced coordination and capacity building on AI across member agencies and also hosted a conference on AI and financial stability, providing an opportunity for greater public and private sector engagement to improve our collective understanding of the opportunities and risks posed by AI. This was the first FSOC conference in almost a decade and included participants from over 75 organizations. The FSOC has an important statutory mission to identify, assess, and address potential threats to U.S. financial stability. A strong and resilient financial system plays a critical role in supporting a strong and robust economy for all Americans. Over the past 4 years, the Council and its member agencies have worked to make the financial system more resilient to both exogenous and endogenous risks to the financial system. And having a more holistic view of our rapidly evolving and dynamic financial system is central to be able to address financial stability and requires interagency coordination and information sharing. As Secretary Yellen noted, over the past number of years, the Council worked to rebuild that capacity and promote more effective interagency coordination and engagement to develop that more holistic view. And the initiatives over this past year and the annual report being released today are representative of that revitalized engagement. Now I'd like to introduce Dr. Stefan Jasowitz, the lead author of this year's annual report, who is an Assistant Vice President at the Federal Reserve Bank of Kansas City. Stefan will provide additional insights into the 2024 annual report by giving an overview of the risks and vulnerabilities.
Thank you, Sandra. This year, the Council identified 14 vulnerabilities in the U.S. financial system that may warrant continued monitoring or additional regulatory or legislative action. The 2024 annual report also provides specific and actionable recommendations to address each of these vulnerabilities. Secretary Yellen already highlighted vulnerabilities in banking, treasury markets, cybersecurity, digital assets, and third-party service providers. So I will focus my time on vulnerabilities in the remaining areas, in the order they appear in the annual report: commercial real estate, residential real estate, corporate credit, short-term funding markets, climate-related financial risks, investment funds, central counterparties, and the insurance sector. I'll first turn to commercial real estate. Signs of increasing credit risk in commercial real estate became more evident in 2024, with slower rent growth, increased borrowing costs, and a continued rise in vacancy rates, chiefly in office properties and to a lesser extent in multifamily properties. These pressures on borrowers have led to increased loan delinquencies, loan losses, and provisioning for banks. The Council recommends that regulators continue to monitor the financial industry's ability to withstand stress from declining property prices and deteriorating loan quality in commercial real estate. Residential real estate is central to the U.S. financial system. Housing prices continue to be high relative to household incomes. While the low supply of housing has been an important contributor to high prices, the housing market could soften should economic conditions weaken, and the Council recommends supervisors and financial institutions continue to monitor residential real estate exposures and the adequacy of credit loss allowances. Moreover, non-bank mortgage servicers could face operational and financial pressures in a weaker housing market. In its report on non-bank mortgage servicing, released earlier this year, the Council made recommendations to enhance the resilience of the non-bank mortgage servicing sector, drawing on existing authorities of state and federal regulators and encouraging Congress to address the risks identified in the report. The Council fully reaffirms the recommendations made in the non-bank mortgage servicing report released earlier this year. Next, I'd like to turn to corporate credit, notably to private credit, which has grown rapidly. This market is an increasingly important source of funding for small and mid-sized firms, which are typically more highly leveraged than those in public credit markets. This growing importance has prompted discussions about potential financial stability risks due to the market's opacity, credit risk, liquidity risk, and increasing interconnectedness with banks, insurance companies, and other institutions. To provide additional insight into any potential risks associated with the rise in private credit, the Council supports enhancing data collection in this market. Indeed, some of this important work has already begun. Short-term funding markets also present financial vulnerabilities. While short-term funding markets play a critical role in the financial system, these markets have also experienced heightened volatility during periods of market stress and have historically been vulnerable to runs. To address these risks, the Council has worked to strengthen the resilience of short-term funding markets and support orderly market functioning during periods of heightened market stress. The Council's review of a broad set of short-term investment vehicles this year found that they share features that can contribute to financial stability risks, including liquidity mismatch and characteristics that may incentivize redemptions during periods of market stress. The Council will continue to assess and monitor the vulnerabilities from short-term investment vehicles and is ready to consider additional actions as appropriate to address financial stability risks. Climate change continues to present financial risks, and the Council has taken steps to better understand climate-related financial stability concerns and transmission channels. In addition to its work at developing a set of metrics to assess climate-related financial risks, the Council recommends that agencies collaborate on analysis related to how the intersection of physical risk, real estate, and insurance may affect financial stability. The Council has also identified vulnerabilities within several categories of investment funds, including hedge funds, open-end funds, and collective investment funds. The Council supports initiatives by the SEC and other agencies to increase hedge fund transparency. The Council also supports the ongoing work of banking supervisors to improve banks' counterparty credit risk management practices with respect to hedge funds. The Council and state and federal regulators should also consider what additional steps are needed to address financial stability risks from open-end funds and collective investment funds. In addition to investment funds, the report discusses vulnerabilities related to central counterparties. Central counterparties are key nodes within the global financial system and can thus introduce potential hazards to the system. The Council supports the continued efforts of the CFTC, Federal Reserve, and SEC to enhance oversight of the 5 central counterparties designated by the Council as systemically important financial market utilities. The Council recommends that these agencies continue to monitor the operational resilience of central counterparties, including the introduction of stress testing for non-default losses. Finally, the 2024 annual report also discusses vulnerabilities within the insurance market. The United States is the world's single largest insurance market. There has been a long-term shift towards non-traditional assets and liabilities and toward offshore reinsurance in the insurance industry, especially within the life insurance sector, and this shift has accelerated over the past year. Given the sector's interconnections with the broader financial system, the shift warrants continued attention. To better understand possible risks, the Council encourages state insurance authorities and the NAIC to increase disclosure of private market investments and offshore reinsurance in statutory financial reporting. The Council also encourages these agencies to evaluate the need for enhancements in specific supervisory tools and processes. Together with Secretary Yellen's remarks, this covers the vulnerabilities highlighted in the Council's 2024 annual report. Before I conclude, I would like to extend my sincere appreciation to Secretary Yellen and all the other members of the Council for your leadership, and to member agency staff for sharing their valuable time and expertise throughout the demanding annual report process. Thank you, and with that, I will turn it back over to you, Madam Secretary.
Thank you so much. Before we vote, I know some council members would like to say a few words. Chair Powell, would you like to start us off?
Thank you, Madam Secretary, Madam Chair. So, incidents of elevated financial stress that threaten the economic well-being of the people we all serve are a recurring phenomenon. And when those times come, we typically see emerging risks that can either fall between the existing remits of these agencies into the gaps between them, or indeed outside the more regulated system. And the cross-agency collaboration inherent to FSOC helps close those gaps, and this report shows that process in action. While the financial system remains resilient, the report identifies important areas of elevated risk, such as credit weakness in commercial real estate and increasing leverage in private funds and at insurance companies. I'd like to commend the FSOC staff, as well as the staff of its member agencies. I want to particularly call out our colleagues from the Kansas City Fed for their help in writing the annual report, and thank all of you for your efforts in detailing these risks and recommendations. The report is, of course, critical to our mission. It would not be possible without your dedication and expertise. Finally, I would also like to thank Secretary Chair Yellen for her adept, skilled leadership of this body over the past 4 years. Thank you.
Thank you so much, Jay. Chair Gensler.
Thank you so much, Secretary Yellen, for your leadership of this council, for reinvigorating this council, for getting us through that 2023 turbulence, and more importantly, for your friendship these years. We first met many years ago, but I'm not going to say the number. I also want to thank my fellow council members and their staffs for the collaborative efforts we've all put together overseeing the financial sector, but of course this annual report. And as Chair Powell said, it's really about ensuring that our financial sector, the risk in the financial sector, don't spill out and hurt everyday Americans. And of course, the financial sector is about risk. We're not going to repeal that. That's an important part of our economy, but it's that it doesn't spill out. We'll vote in a moment on the annual report, which I support. I would note a hat tip to Marty Grunberg. He tells me this is the 10th annual report that you've been on this council for. Is that right?
That's my rough count, but
yeah,
I'd have to check the record.
Yeah. Secretary, Madam Chair, I think it's your 8th. So Chair Powell and I are behind you right now, but Chair Powell, God willing, you'll catch up with Chair Secretary Yellen and catch up to be 8th. But look, I just want to say a few words about the council and some risks. I think this council was formed in the aftermath of the most significant financial crisis of all of our lifetimes. I was honored to be at that inaugural meeting in October of 2010 when Secretary Geithner was chairing it. And at its core, our FSOC brings together the various regulatory perspectives that we all represent, and as Chair Powell said, to ensure that there's not gaps or that we just talk about those cross-cutting things, really to prevent fires in one corner of the financial system spilling out into the public and hurting the public. I mean, I think of it, that's the core. Today, our U.S. economy is remarkable. It's importantly benefited by a vibrant financial sector, which is dominated, if I might say, by $120 trillion capital markets, $26 trillion banking and credit union sector. So you can see that ratio is quite remarkable. About 5 times the size of the banking sector is the non-bank financial intermediation, if we call it that. I think it's one of our comparative advantages as a nation. It's very different than Europe and Asia, which has a reverse ratio. I believe it's a feature, not a bug. But let me be clear, it also has risks. And at the SEC, we need to promote that resiliency, but this council is what's involved in that resiliency. And that's what we've been doing at the SEC with all of your help and with Secretary Yellen's every once in a while, that constant guidance. That'd be guidance with quotes. But that's what we've done, really, at the SEC. It's why we adopted reforms in the $7 trillion money market fund sector. It's why, along with 3 or 4 other agencies here, we adopted really important reforms in the U.S. Treasury market. Why Russ and we did updates on private funds information gathering and on and on. I mean, it's why we shortened the settlement cycle in our equity markets, and why I'm very proud that actually Americans, for the first time, who have accounts at broker-dealers and investment advisors will get notices if their private information is hacked, and that they can help protect themselves if there's a cyber event. But the job of the council is never finished. Financial markets are always changing. Technology and business models change. I think there are risks, one that you highlighted, which we've all talked about. We talked about today in the quiet private session about the significant leverage in the macro hedge fund space and the intersection of that to the banking sector through prime brokerage. So I think that's going to be a critical thing to continue to watch, monitor, and actually I think our Treasury market reforms help in part there. I think number 2, artificial intelligence is a very big plus to our economy. It already has been, but it also comes with risk because finance, since antiquity, tends towards concentration, tends towards centralization. And I think we're going to have risk when 8,000 to 10,000 financial firms are relying on 1 or 2 or 3 base models, as they currently do. 3/4 of the entities we oversee rely on 2 cloud providers. And if you want to add the third, then 90+% of what we all oversee. So I think that's a real risk. And I guess I couldn't leave without saying something about crypto. So I think without compliance with our time-tested rules related to disclosure conflicts, business conduct, investors will get hurt. We've seen this. We've seen this over these 4 years. Not billions, but tens of billions of dollars of investor harm. How has that become systemic? It can become systemic in multiple ways, but it undermines the trust and integrity of our broader capital markets. It can also affect and infect the banking sector, but at its core, it's also about investor confidence. Look, I deeply believe in markets and the benefits they bring to the economy. Having worked around them for 45 years, 35 years ago, I met Chair Powell when we were kicking around Wall Street. I also would say this, financial stability can hurt everyday Americans, and that's why I want to thank everybody here, colleagues, but particularly Secretary Yellen, for these past 4 years. I want to say something to those who will fill these seats in the future. I really do think that it's a privilege to serve, and that privilege comes with the responsibility to look out for everyday bystanders to the highways of finance. So thank you.
Thank you so much, Gary. Chairman Grunberg.
Thank you, Madam Secretary. If I may, let me begin by thanking the FSOC staff, as well as the staff of the FSOC agencies who prepared this annual report. As Chair Gensler suggested, I have some perspective on these annual reports, and I continue to be impressed by the value of the requirement that the FSOC produce an annual report summarizing in one place the collective financial stability risks confronting the United States. We've really, over time, I think, derived enormous value from that annual exercise. As the report notes, the banking industry continued to show resilience in 2024 following the failure of 3 large regional banks in the spring of last year. However, the industry continues to report weakness in several loan portfolios, including commercial real estate and credit cards, as well as deterioration in multifamily loans. Many banks also remain reliant on uninsured deposits and the liquidity risks they pose, which contributed to last year's regional bank failures. I appreciate the report's recommendation that the banking agencies finalize a proposal to improve the resilience and resolvability of certain large banks by requiring them to maintain outstanding long-term debt that can provide additional loss protection for depositors and the Deposit Insurance Fund. Importantly, the report also encourages the banking agencies to complete the Basel III capital reforms to further enhance the resilience of the banking system. In addition, the report notes that risks involving third-party service providers continue to be a financial stability concern. These providers deliver products and services to financial institutions, and the arrangements they make with banks have become more frequent and complex. The failure of Synapse, a third-party provider of deposits to banks, resulted in thousands of depositors being unable to access their accounts and illustrated the need for banks to maintain adequate controls. I particularly want to commend the annual report's discussion of the Council's extensive work this year on risks in the non-bank financial sector. The Council members worked to analyze and address high leverage in the largest hedge funds, and their interconnections with Treasury markets and the banking system is really essential work that should be an ongoing priority. This year's FSOC report on non-bank mortgage servicers provided important recommendations to improve the financial stability of mortgage markets going forward. I also appreciate the report's attention to the rapid growth and risks of private credit. The opaque nature of private credit makes it difficult for regulators to assess risk management practices and the buildup of interconnections to the financial system. Finally, I appreciate the report's support for resources to be set aside for the resolution of central counterparties. These resources are essential to continuity to ensure the resolution authority has what it needs to maintain operational continuity of the critical services these firms provide. I would also like to acknowledge the rulemaking by the SEC and the proposed rule by the CFTC to strengthen the recovery and wind-down plans for CCPs on which they worked collaboratively with the FDIC. Let me close by thanking the Secretary for her strong leadership and commitment to the work of the FSOC and its important role in fostering cooperation among the responsible agencies of our government to address financial stability risks. I would also like to add what a pleasure and privilege it has been to work with Secretary Yellen during her exceptionally distinguished tenure at the Treasury, as well as with all of my colleagues on the FSOC. Thank you.
Marty, thank you so much. Acting Controller Sue.
Thank you, Madam. Oh, there we go. Thank you, Madam Secretary, for your leadership of the Council. You have restored the capacity, the credibility, and the effectiveness of the council, encouraging us to collaborate, to think outside the box, and to be disciplined in doing the analytical work to serve the American people. The annual report is a fitting reflection of all the hard work the council has done this year. Its recommendations cover both traditional and emerging risks, from cybersecurity and commercial real estate risks in the banking system to the growth of non-banks like mortgage servicers, hedge funds, and private credit funds, to AI, digital assets, and climate-related financial risks. I support the issuance of the annual report and its recommendations. I'd like to thank again you, Madam Secretary, as well as Deputy Assistant Secretary Sandra Lee, for your leadership, and to thank the staff at FSOC and the member agencies who have dedicated their time to this report and to FSOC's other initiatives this year. Thank you very much.
Thank you, Mike. Director Chopra.
I think we're a little short on time, so I'll submit my prepared statement, but let me also thank you for not only all of your firsts and boundary-breaking career, but also for bringing the heart to the job of that the work we do is not technical, but it is really about individual people and the lives that they lead, and that is just so important. Let me just share that regulators, we really tell financial institutions of all types that they should monitor and manage risks. I think we've done so much to make sure that this body is helping to monitor them, and a future FSOC will really need to make sure to take actions that they will manage and address those risks. The annual report lists so many of them. Our executive sessions, I know I leave them with my heart rate increasing because of the complexity of our financial system and often the risk that is built into them. I just share that one of the mandates of this body is to change the expectation of financial institutions that they will receive bailouts or emergency measures to support them. We still have a long way to go to change that perception so that they are incurring the costs of those risks rather than people who don't always get that support when they need it. Thank you.
Thank you very much, Rohit. Chairman Benham.
Thank you, Madam Secretary. Very pleased to support this year's report. Deputy Assistant Secretary Lee, Stefan, thanks for all your work, and to the entire council for all of the work. Goes without saying, I think, among this group that our country leads the world in the depth, strength, and innovation of our financial markets. And obviously, as was said earlier, the increasing complexity and interconnected world exposes it to considerable risks and vulnerabilities. So this report identifies a number of issues and vulnerabilities, which were mentioned already, that are of significant interest to the CFTC. And just to mention a couple, first and foremost, central counterparties, something that is number one on our agenda, mission, and priority list in terms of risk. And we continue to monitor them very closely, working with other council members. Cybersecurity also, as was mentioned, continues to be a significant vulnerability for the U.S. markets in an area that we are keenly focused on. And I will mention, as Gary did and Secretary, you mentioned as well, the first Bitcoin futures contract was listed at the CFTC in 2017 on 2 exchanges. Today we have 8 different platforms registered with us, and we have over 18 different tokens trading. So this is not going to change. It's going to continue. And as we mentioned, as the report reflects, I think it's going to be very important for Congress and the member agencies to properly regulate this area so that we eliminate or at least reduce the vulnerabilities that it presents. Madam Secretary, it's been a pleasure to work with you under your leadership. Thank you for everything you've done, and certainly look forward to the work that you've done being continued in the future.
Thank you so much, Russ. Director Thompson.
Thank you. Thank you, Madam Secretary. I really appreciate the opportunity to work with this council, and I do want to thank Sandra Lee and the FSOC staff and Kansas City as well for working on this really robust report. And I did just want to focus on one particular topic that's highlighted in the report, and that's the housing affordability, which remains a persistent challenge nationwide. And the annual report really highlights this unique economic challenges presented by the ongoing housing shortage. The imbalance between robust demand for single-family housing and an inadequate supply has caused prices to rise throughout 2024. Home prices are now up by more than 50% in the last 5 years, and when combined with interest rates that are well below pandemic lows, many aspiring home buyers have experienced difficulty finding affordable homes. The problems with housing affordability have been exacerbated by changes in the market for homeowners insurance. Areas prone to natural disasters are facing significant increases in the price of insurance and decreased availability in the primary insurance market. Even when insurance is still available in these markets, some insurers are raising prices to cover the rising cost of natural disasters, which heightens home affordability concerns and strains household balance sheets. Ultimately, more and more borrowers will be faced with renewal concerns or difficulty obtaining affordable initial insurance policies when they buy a home. And this is why the Secretary's 3 C's, as I call them, cooperation, collaboration, and coordination, are going to be critical as we really try to focus on this housing sector, insurance sector, banking sector, and all of the relevant participants. I do want to thank the Council for once again recommending that FHFA and NCUA be granted examination and enforcement authority over third-party service providers. The role of the third-party service providers has expanded significantly since FSOC first made this recommendation in 2015, and this is a critical tool to help FHFA ensure the safety and soundness of its regulated entities. And thank you for the opportunity to work together.
Thank you, Sandra. Chairman Harper.
Thank you and good afternoon, everyone. We have Secretary Yellen's outstanding leadership to thank for much of what the Council has accomplished during the last 4 years. Indeed, it has been her reinvigoration of the Council that returned this body to its roots, being an active, adaptable, and collaborative group that closely monitors existing, evolving, and potential threats to financial stability. Among our many achievements, I am proudest of last year's publication of the non-bank designations guidance and analytical framework. The old guidance was an endless game of chutes and ladders, but the new workable guidance incorporates clear, balanced, and consistent processes that are faithful to the Dodd-Frank Act's requirements. Let me pause here to thank Sandra Lee and the entire FSOC team for their hard work on numerous initiatives, including this year's insightful annual report, which I support. This report highlights several systemic risks issues specific to the credit union system. The NCUA's lack of vendor authority over third parties is a growing regulatory blind spot that has real-world implications. Like Sandra, I will note that this Council has made this recommendation since 2015 for Congress to act, but the risks have only grown. Late last year, for example, a cyber incident at a core credit union service provider disrupted basic services for credit union members across 40 states. The reality is that risk frequently grows in the most unregulated shadows of the financial system. Congress needs to close this regulatory loophole. For the first time, this annual report also aptly recognizes the need to anticipate and mitigate the likelihood of large credit union failures, especially with system assets heavily concentrated in a few large institutions. As such, this annual report recommends that the NCUA should both increase the reserves held in the Share Insurance Fund and be granted additional flexibility in how it manages the fund. Under existing law, the NCUA's power to raise reserves is fundamentally constrained, which hamstrings the agency's ability to leverage periods of economic financial strength to prepare for times of upheaval. If Congress raised the equity ratio ceiling, the NCUA board could do more at the right time to substantially strengthen the resiliency of the fund and prevent a repeat of the 2008 corporate credit union crisis that led to Congress to pass emergency legislation to protect the credit union system from a cascade of credit union failures. Lastly, this annual report underscores the need to finalize the long overdue regulatory action on incentive-based compensation in accordance with Section 956 of the Dodd-Frank Act. Earlier this year, the NCUA joined several other agencies in issuing a proposed rule to establish disclosure and reporting requirements for incentive-based compensation agreements. Having worked on Section 956 as a congressional staffer during the drafting of the Dodd-Frank Act, I understand the importance of having all 6 responsible agencies come together to finalize work on this statutory mandate. Financial executives have a responsibility to steward their institutions with a focus on long-term organizational health and not on short-term personal gains. Effective rules, not unenforceable guidelines, will best allow the regulators to protect shareholders, job holders, and householders from the excesses caused by greed. We need to finish the job to uphold transparency and accountability across the financial system. In closing, the Dodd-Frank Act established this council to actively research and monitor the financial system for potential risks and to then act when identified vulnerabilities are not sufficiently addressed. Our work here matters to the people living and working on Main Street by protecting them from the excesses of Wall Street and the risks lurking in the shadow of the regulatory system. We cannot allow a repeat of the great financial crisis when unemployment peaked at more than 15 million Americans and 10 million Americans lost their home. Going forward, the Council must remain vigilant against the many threats to financial stability and stand ready to act by actively monitoring all corners of the financial system, designating systemically important financial institutions and financial market utilities, subjecting both of those to heightened scrutiny, and if necessary, breaking apart those entities that pose a grave threat to the financial system. That's exactly what my old boss, the former Congressman Paul Kanjorski, intended when drafting the too big to fail language that became Section 121 of the Dodd-Frank Act. And it was his prescient vision that guided my work on the Council these last 4 years. Thank you.
Thank you very much. Independent Member Workman.
Thank you, Madam Secretary. I want to begin by expressing my appreciation for the excellent work that is reflected in the annual report. I think it's an excellent document, and particularly in the insurance area. Also, Madam Secretary, I have greatly appreciated the opportunity to serve as the independent member with you and with the other members of the Council as well over the past 4 years. This, of course, has included the opportunity to get to know the members of the Council and many of the deputies and FSOC staff members. Important work has been done. I certainly recognize that, and I am grateful to have been a part of it. Thank you.
Thank you. Superintendent Harris.
Thank you, Secretary Yellen, for your leadership of the Council and the Treasury Department. It's been truly an honor to serve under your leadership. And thank you to my fellow regulators for another productive and collaborative year working to protect the American people, the institutions we regulate, and the global financial system from new and emerging threats. I'd also like to thank my good friend Sandra Lee, the Treasury staff, and detailees for putting together this year's annual report. I know how much work goes into producing the report, and your tireless efforts are noted and appreciated. The report is a cumulative record of the extensive work that the FSOC has done this year. In 2024, we addressed a number of new and developing risks that are key areas of focus for state regulators, including digital assets, non-bank mortgage servicing, and the use of AI in financial services. This year's report continues to highlight the growing interconnectedness of digital assets and traditional financial institutions. New York DFS appreciated the opportunity to contribute our experience and expertise as a representative of the states to this Council. I will note that this year's report amends the Council's previous recommendation and now focuses exclusively on the federal role for comprehensive stablecoin regulation. We share the goal of establishing a national framework to protect consumers across the country, but note there is an important role for states to play in the regulation of innovative financial services. States can act nimbly in response to industry developments, to modernize regulation more quickly, and to support responsible innovation. I'm proud of the leading work that New York and other states have done to establish strong regulation of digital assets. New York DFS, of course, was the first to provide regulatory clarity in this space, has the most rigorous framework anywhere in the world, and has protected consumers and created a strong, resilient market for digital assets businesses across the state. Any legislation should take advantage of state and federal expertise and the states look forward to continuing to work with Congress as they develop a strong regulatory framework at a federal level. Likewise, I appreciate that the annual report reaffirms this Council's commitment to implement the recommendations from the report on non-bank mortgage servicing. As the primary prudential regulators of non-bank mortgage companies, states have been leading the way. We have established model prudential standards and have adopted new processes and tools to license and examine these institutions on a multi-state basis. Given the market's rapid growth, I support greater collaboration between state regulators and federal agencies to enhance the supervision of the non-bank mortgage companies. Stronger coordination across all levels of government will better protect homeowners and the housing market. I appreciate the opportunity that FSOC provides to bring together regulators from different levels of government with different perspectives and experiences. I am proud of the progress we have made, and I am proud to represent the innovative work happening in states across the country. The issues we face have no simple solutions. By continuing to tackle these challenges together, we will more effectively meet our shared mission of protecting consumers, ensuring the health of the entities we regulate, and preserving the stability of the global financial system.
Thank you very much. Commissioner Lubin.
Thank you, Secretary Yellen, for your leadership of Treasury and of FSOC. State securities administrators greatly appreciate the efforts made by the FSOC team to produce this year's annual report. The report contains important legislative recommendations relating to the uses of blockchain and distributed ledger technologies. Specifically, the report recommends that Congress take action to address perceived gaps in regulation of certain digital assets. I believe we all share the same goal of ensuring that the United States has a robust, whole-of-government approach to promoting innovation responsibly in our capital markets. In particular, I want to acknowledge the collaboration between state securities regulators and the CFTC and SEC on a variety of enforcement matters. These collaborative efforts have helped to ensure that investors receive the protections that they are entitled to in our financial markets. Information provided by the state securities regulators shows that investigations and enforcement actions remain heavily focused on technology and digital assets. In 2023, states reported opening more than 340 investigations involving digital assets, not including matters involving NFTs and staking products. The number of reported investigations involving technology and digital assets increased significantly from the numbers reported in 2022. Our data indicates that digital assets other than staking and NFTs were involved in 50% more enforcement actions than the next highest product. These state enforcement actions include shutting down digital assets frauds targeting local communities, as well as larger unregistered offerings involving investors across many jurisdictions. Despite these numbers and the devastating financial losses suffered by Main Street investors, NASA is concerned that the recommendation in today's report do not sufficiently address the need to ensure robust investor protections through maintaining state regulatory authority. It is clear to us that in addition to state authority, any legislation establishing a framework for digital assets and distributed ledger technologies must maintain long-standing legal principles, such as the Howey investment contract analysis, the foundation upon which many anti-fraud enforcement actions have been based. Without this much relied on precedent, securities regulators likely would have been unable to take action to stop bad actors from harming investors. To ensure that these critical investor protection efforts continue, federal legislation relating to the use of blockchain and distributed ledger technologies in our securities and commodities markets must maintain a robust role for state securities regulators, particularly in the area of anti-fraud enforcement. Capital follows trust, and foregoing such authority will not only harm investors, but also harm the innovators and companies in need of investment capital. I appreciate Treasury's consideration of NASA's concerns. We will continue to engage with Congress and the administration to ensure that states retain the authority necessary to protect investors and maintain trust in our capital markets. Thank you.
Thank you. Are there any other questions or comments? Okay, seeing none, let's go to voting on the annual report. Is there a motion to approve the resolution approving the Council's 2024 annual report? Thank you. And second?
Second.
All in favor?
Aye.
Any opposed? The resolution is approved. Our last agenda item is to vote on the minutes of the council's October meeting. Is there a motion to approve the resolution approving the minutes of the October 18th council meeting?
So moved.
Is there a second?
Second.
Thanks. All in favor?
Aye.
Any opposed? The resolution is approved. So let me say thank you to everyone. This concludes our meeting for today. And before we go, I want to thank the council members for their kind words and for their collaboration and engagement over the last 4 years. It's been a pleasure to work with all of you. And I want to thank Sandra Lee and the staff of FSOC for amazing work in providing the analysis and direction that's enabled us to, I believe, leave a stronger and more resilient financial system that benefits all Americans. I am proud to have worked with all of you together to achieve the council's mission. I guess I need a motion and a second to adjourn the meeting. Can I have a motion? Thank you. And second?
Second.
Thank you, everyone, and best wishes for the holidays. Thank you. Thank you for your words.
Maybe after January 20th we can get together.
I think that would be terrific.
I'll have to find out.
Yeah.